stories, how you use them.
T-minus 3, 2, 1, 0, and liftoff.
Greetings. Rolling up my sleeves, we've got some things to talk about today. We have some very interesting stats out there on savings rate, excess savings, and what really happened in the economy during Q3. We're sitting here in early November of 2023, looking back to Q3, and there's some stuff that you can use and you can understand and very appropriately apply it to your business, whether you're running a t-shirt company in Berlin or a tech company in Southern California. I've got stuff that you can apply to because I want to leave you better than I found you, and I think I will. We're also going to go into Lucid, and thank you very much. There were 3 people that sent very detailed notes to a case study last week and the week before, and they had really breakdowns of what they wanted to see from Lucid, and we've got exactly that. The case study today will be Lucid. Businesses today are facing a rough world. The stock market is in an angry mood, as is the economy. Banks are failing, inflation is never ending, and a looming recession threatens to wipe out stock value. That's bad for business, but even worse for retirement funds, especially if you're the one getting ready to retire. And to make things worse, the government is targeting those retirement funds, your 401ks and your IRAs, with heavy new taxes to pay for things like social justice agendas and federal deficits. The good news is that there is a way to help protect your financial future: investing in precious metals. American Hartford Gold will ship physical gold and silver directly to your door. Or they can set you up with a gold IRA, where you can invest in gold that shows up in your IRA. The gold IRA can shield your wealth from this economic meltdown, and the best part is this method is tax and penalty free. That's right. Analysts predict that gold is set to hit all-time highs. If you have retirement funds that you cannot afford to lose, now is the time to call a precious metal dealer. And here is the only precious metal dealer that I, the Biz Doc, currently trust: American Hartford Gold. They'll show you how to protect your savings and retirement accounts by diversifying your portfolio from stocks, mutual funds, and other things with physical gold and silver. With the finest products, fantastic customer service, and a buyback commitment, American Hartford Gold has earned a 5-star rating from thousands of reviews and an A+ from the Better Business Bureau. Tell them the BizDoc sent you, and they'll give you up to $5,000 of free silver on your first order. Click the link in the description below or call 866-535-0767. Again, on your screen, 866-535-0767, or just text BIZ, B-I-Z, to 65532. So first, let's dive right into it. So Americans' excess savings. What is excess savings? Excess savings is like long-term savings, and excess saving is important to note, especially in the face of GDP. And GDP is nothing more than gross domestic product, or what we all made, consumed, and whatnot. And in Q3, boy, we had a really good Q3. It was like 5% growth, 4.9, I think is the official number. And they said it was fueled by consumers. Well, it was fueled by consumers because the following 3 things happened. Number 1, they used up their savings. Number 2, they took credit cards from about $500 billion all the way back to $1 trillion. Yep, $1 trillion. So $500 billion was spent somewhere between right at the end of second quarter and the end of third quarter. So the consumers spent money they didn't have, because if it's on the credit card, now it's a balance. They didn't pay it off. Money they didn't have. Then the third thing was HELOCs, home equity line of credit. We all know houses are up and very expensive. Well, for the 40% of Americans that actually own a house, they've been using that balance. It's like, hey, all of a sudden I noticed my house was $300,000. Now it's worth $450,000. I can go to the bank, get a $75,000 or a $50,000, even a $100,000 HELOC. I'll tell them I'm going to work on the kitchen. Well, that is happening a little bit, but if you look at Lowe's and Home Depot stocks, they're not really moving. And you look at their earnings report, they're not really going very far. Why is that? Because they're not using the HELOCs to go buy a bunch of stuff and to fix up their kitchen or even redo it. Not happening. Those HELOCs, people are worried that it's a sign of desperation that the consumer's doing it. But now we're going to show you what happened to excess savings. So let's pop up the first chart here. Okay. So, for those of you that are listening on Spotify or just listening to the audio version, I'm going to narrate the chart for you. So if you're driving along or you're working at home at night, you can understand it. And thank you for listening. For those of you that may be watching on video on Spotify or video on YouTube, so you can see the chart. So we have a chart here that shows from 2018 to 2023. And there's this blue line that goes up very, very high over the course of 2020, 2021. And that blue line represents disposable income above average. So people had more disposable income. Why? Well, because they weren't going to the movies, they weren't going out to theme parks, they weren't going to restaurants. Why? It was COVID and we were all locked down. So disposable income, the blue line shows that it's going higher. So if you can just visualize that if you're listening on the audio version. Then the actual consumption is a red line. The red line dipped during COVID. Why? Well, what I just said, they weren't consuming those things. They weren't buying tickets to movies or theme parks or restaurants or out and doing anything, concerts, because it wasn't happening. They also were shopping less. A lot more groceries and things were bought through delivery, but overall shopping was down and credit card balances dropped because people took a lot of the money they were earning and government stimulus checks, and they paid down credit cards. We know they did that. Well, all of a sudden, the blue line is real high, meaning a lot of extra money, and the red line was low, meaning not consuming, and all of a sudden they cross. And the blue line, which is disposable income, is below the red line consumption. Well, if you're consuming more than you are having a disposable income, you know what the difference is? You put it on your credit card because you didn't have the income, but you were still buying stuff. And that's exactly what this chart shows. And it shows exactly what happened in Q3 in the United States of America. You're hearing notices and you're seeing and hearing headlines that say, Q3 was fantastic. And then the fine print, they say, well, it was a 5% growth in Q3. And now everybody's saying, Goldman Sachs, Morgan Stanley, the big analysts, and they don't have a dog in this hunt. They are merely trying to put the numbers out there, and guess what? 1.2 is what they're predicting for growth in fourth quarter. Why? Because going into HELOCs, $1 trillion on the credit card, the consumer is starting to get tapped out, and you can see the red line and blue line coming together toward the end of Q3, meaning that all that excess consumption they were doing, where they were consuming more than their disposable income, spending more than they earned, is squeezing to a halt at the end of Q3, going into Q4. So there you go. So that's what happened. And how is this going to, sustain going forward? The answer is it's not. You're going to have issues in fourth quarter. What does that mean for you and me? So if you've got a business and you're depending on the consumer, a B2C business, you know what? You need to just, you may have to spend a little bit more on marketing, so maybe a little bit harder in the fourth quarter to find sales than it was in third quarter. But watch your money and be tight. Now is the time to be prudent, but also be creative. Be creative and don't spend excess, but maybe you need to trim certain things down. Maybe you don't need to replace certain laptops or computers at your business right now. Maybe some of the excess stuff you can set aside spending on. I would say on your best employees, still take them to lunch and do that, but be ready to tighten up a little bit in Q4 because the consumer may not be buying the way they are. And we're also seeing that ready for this? Shock of shocks. Here we were, Q3, the percent of jobs created dropped dramatically, and it's dropped again here at the beginning of Q4, which means that the creation of jobs is slowing down dramatically. Why? Businesses are already feeling it. They're already seeing it, and they're hiring at a slower rate. So it's a time for caution, a time for batten down the hatches a little bit. Now we're going to take a look on a global sales. Say, Biz Doc, you're talking about the United States. What's going on around the world? Well, let's go to the next chart, and I'm going to show you savings rates. Again, for those of you listening at home, I'll narrate this through. So we have the United States, Europe, the UK, which is England, Ireland, and all that, Japan and Canada shown. And the blue bars are the savings rate before COVID. United States, people were saving about 6% of their income. Same thing in Europe. The UK, very low, about 1%. Japan, only about 1%. Canada, about 2%. Then it shows a gold bar that jumps way up during COVID. It's what we were just talking about. People were saving. The United States savings rate was 13% during COVID. Europe, 12.2%. The UK was actually not a saving, country these days. It's a Commonwealth, everything's going on over there. You have Ireland, Wales, England, and all that makes up the UK. So suddenly they were over 8%. Japan was over 8%. Canada was right there with the US, over 12%. But then after COVID, check this out. Europe goes exactly back to their same savings rate as they did before COVID. The UK is saving more than they did before COVID. They're about 2% and they were less than 1%. So in other words, they're now saving a little more. Japan, they're almost 4% when they were under 2%. And Canada's savings rate right now is almost 6% when it was 2% before. So all those ones I just mentioned, what this chart shows is the savings rate now is higher than it was before COVID. Meaning, man, they got religion and now they're trying to protect themselves and their family by saving. The United States, it was a 6% savings rate. Now it's a 4% savings rate. Boom, there's my point. There's what happened to GDP in Q3. Americans suddenly are just spending and they're not saving as much. So if the rainy day hits the global economy and we do have a recession in next year, which I believe we're going to have, and I believe we're already seeing the signs of it, and we need to be managing our lives, our careers, our spending, especially if we're running businesses, tighten up a little bit and just be ready for it. Guess what? United States is not savings. And you know why? Because Uncle Sam bailed us out and they sent out all these stimulus checks. It's an election year for Joe Biden. And, he's just going to, wow, all of that stuff that people may be thinking, probably not going to happen this time because it can't. The United States has got trillions of dollars in extra debt. So that's what's going on, folks. If you heard anything about the excess savings rate and GDP in Q3 being fueled by the consumer, that's correct, and I will just break it down. Now, by your request, we are going to go and we are going to do the case study for Lucid. And I'm going to grab my vault here. This one is Cucumber Mint. Unlock your brain. Let's see if we can unlock your brain with some facts and figures on Lucid and dive in the story of this EV, high-end, really high-end EV. It's like the Mercedes of EV. These are high dollars. A lot more features to them. This is not a Tesla Model 3 or a Fisker Ocean, like I have. This is ultra high-end stuff. So let's go. Let me go find studio, grab my vault, and get back to you. All right. I found my board, Studio B, and my vault. Awesome. Unlock your brain. Have a tasty vault. All right. Well, thank you very much for your request. What we're covering today is Lucid. The EV company known for the Lucid Air vehicle. I'm going to take you through a quick little bit of history, and then let's talk about why are they in the headlines and what's going on, because you asked me to cover it and you're getting it. So Lucid, where did it begin? It was founded in 2007 and it had a different name. It was Atieva. And the Tesla VP, Bernard C., was part of it, along with co-founder of Astoria Network, Sam Wang, an inventor, named Xiaopeng Lin. I may have butchered that name, do the best I can with it. And originally they were going to focus on building EV batteries and powertrain for other manufacturers. That's what they were going to do. They're still doing some of that today, but it was all about, no, let's go build our car, the Lucid Air. And the CTO, Peter Rawlinson, would later become the CEO, and he was, believe it or not, a chief engineer of the Tesla Model S. So when they're coming together and they're trying to get investment from people, people are saying, wow, you guys know what you're doing. You're all coming across from these technology areas, and Peter coming from Tesla themselves. Wow, this is going to be a competitor to Tesla? Well, not really. We intend to build higher-end cars, probably just a little bit above Tesla. Okay, well, let's see how that goes out. There he is. By the way, there's Peter. Looking today, not as young, not as happy as he once was, because he's still working hard with what's going on with Tesla as a competitor and with the stock market for Lucid. So, a quick history. They rebrand Lucid Motors back in 2016, and they announced that they're building what they're calling AMP1, Advanced Manufacturing Plant in Casa Grande, Arizona. Okay, fine, so now you got yourself a factory up there going on. And then 2018, but they spent their time building this and getting it all done. 2018, Saudi Arabia Public Investment Fund, PIF, says, hey, we're going to invest $1 billion in this, and we have an agreement for them to build AMP2 near Jeddah, which is the second largest city in Saudi Arabia. So, and we're going to be building these. This is the Air sedan. It starts at $75,000 all the way up to $250,000 in what they call the Air Pure, Air Touring, Grand Touring, and Sapphire. The Sapphire is $250,000, but with crazy horsepower, up to 1,234 horsepower and a 500-mile range for the Sapphire, and then a lot less than that for the others. But it's a beautiful mid-sized sedan. So they said, hey, we're going to be the BMW, Mercedes of all this. We're going to be somewhat above Tesla. But the Model S kept getting refined. And the Model S Plaid, that thing is, close to $200,000, depending on how you have it outfitted. And so it ends up they're sort of competing at the high end with the Model S. Maybe they're a little bit above it, just a bit above it, and arguing that they've got more and longer range and a lot more horsepower. Nonetheless, good-looking car. So in addition to the Air, they announced, they were kind of teasing talking about it back in 2020, the Gravity SUV. Pretty good-looking vehicle, going to be adding to the line. So they have the Air and the Gravity built by Lucid, but this one will be rolling out in 2024. Probably 2025 because they haven't really been on time with stuff, although they're making announcements and teasing these things because they hope to drive the stock price for people thinking, wow, all these products coming, everything going on. Then they go to the era of getting on the stock market, which is what I just mentioned. They're trying to help with the stock price. First in 2019, Peter Rawlinson was named CEO, going from CTO. Then they completed AMP1, remember the Advanced Manufacturing Plant in Arizona, with a lot of room to expand on the property they built. And then in July, this is 2 years ago, a little more than 2 years, they do a SPAC IPO and get $4.5 billion out of it. $2.1 billion was from the SPAC itself. And again, SPACs is kind of a shortcut to get your company onto the stock market. You merge with sort of an empty company that's already on the stock market, and ta-da, you're on the stock market, and you announce that you're changing the name, it's really you, and that old empty company is gone. So that's a short explanation of how a SPAC works. Then there's usually money in a SPAC too, and in this case, $2.1 billion from the SPAC, and then $2.5 billion in PIPE, which is a way of private entities or individuals investing in public stock, not buying it through an offering on the stock market. So a PIPE was another $2.5 billion from the Saudis, and they paid a premium because SPACs usually go out at 10. The premium they paid was 15. So gave a valuation of the company about $24 billion. And the Saudis own 60% of it. So now they got $4.5 billion, and what could possibly go wrong? Well, they go out and they go all the way up to here, into the 50s per share. Then it goes down again, and then in the middle of COVID, they hit a high watermark there. That was a big deal. They've been sliding down with announcements and delays in delivering the cars ever since, unfortunately. And, $91 billion was the peak in 2021. That was the implied value in the stock market when the stock was this high. Now it's under $9 billion. And by the way, that peak evaluation in November 2021, they had delivered under 200 cars. So this is all future hype and everything. And as the losses and everything go out, this is a real company with real factories and real things going on, but they don't have any profits sitting out there, and they don't really have a path to show that very clearly. And so now they're sitting there at $3.80 a share, and the valuation is at $9 billion. That's 93% off of the peak valuation here. So they need to start delivering cars and find a way to show that the profits are rolling forward. So let's take a look at how that works in EVs, because you're not expected to have profits if you're building factories and having marketing and then selling cars. You're not going to have profits for a while, but at some point in time, the market can lose patience with you. That's what's happening to Lucid. Markets losing patience. So what's up? First of all, What are the problems they have that are causing the market to lose patience and not support them as well? First of all, they announced they were cutting the price of the car anywhere from $5,000 to $12,400, depending on what model you made, and certain of those vehicles are not eligible for the government's $7,500 subsidy that maybe a small Tesla Model 3 might be, or the small Nissan or the small Toyota. They get access to the $7,500 government subsidy. Lucid, at the value of this vehicle, higher-end vehicle, does not. And so revenue was down because they made the price cut. That's never good. Hey, you guys hardly are out there. You haven't moved your 10,000th car yet, and you're already cutting the price? What's going on? Well, sales and productions were down. They only produced 1,500 cars in Q3, sold 1,457 of them, and the annual total down to 8,500 from 10,000. So now you've cut the price, you're not making as much, and the market starts saying, wait a minute. Are people buying your car? Are you getting enough orders? Well, we're going to find out about that in just a minute. And then Aston Martin announces a partnership that they're going to provide motors and batteries to Aston Martin. Remember in the beginning that the original intent of the company wasn't to have their own car with the risk of designing something that the consumers would like. They were going to build batteries and motors for others. Well, they announced they're going to do it for Aston Martin. But they're still trying to be a car company selling their own car. So that's what's up. With all this stuff up here, the market lost confidence. Now let's talk about EV headlines in general. Because if you go out to build an EV, there is a reasonable point of time where you're going to have big losses. And all the losses are is you're building a factory, you're designing your car, you're getting your battery vendors, all the things you have to do, and you're going to lose money on that because you haven't sold any cars yet. And you design a car, and then you got to get the cars, there's regulations. You have to do crash testing and a lot of things. So you're going to have losses until you sell those first cars, and then the losses drop down as you go out and sell them. That's what happened with Tesla. So let's go take a look at this. So now, EV makers lose money per vehicle. They need subsidies. You hear this headline, let's dive into it and see if that's a true headline or it's just business media writing headlines that really aren't that true. Take a look. Ford lost $62,000 per car in Q3. What they did is they took the number of EVs that Ford sold, the Lightning pickup and whatnot, and they took the loss from EVs that they said they had, and they divided it. Oh, you lost $1 million, but you sold 1 million sticks of gum, so you lost $1 per stick of gum. You see how that would work? Well, they're diving into the numbers to do that, to say Ford lost $62,000 per car. Lucid lost $227,000 per car because they only sold 1,500 of them, and they have all those costs for the factory and everything. Did they lose that many per car? Yes, but take a look at this. You look at Rivian. In Q1, they compared the losses to the number of Rivian trucks sold. It was 124,000. They compared the losses to the number of Rivian trucks sold in Q2, 67,000. And in Q3, 30,000. Do you see it dropping down? It's because Rivian's going in the right direction. And a couple quarters from now, they're actually going to be making money. So when you see headlines like this, a lot of times business headlines, you have to do a little decoding. And I hope I just helped you with some decoding. They didn't actually lose this much per car sold. That's compared to the total expense and loss that the company had. So massive EV investment is ahead of profits. And the EV market is having reality starting to emerge. The early adopters in the US, the people that are willing to pay a little bit more, they believe that it's about done. That between Lucid and Rivian and all Tesla, and Fisker, vehicle I own, a company that I'm invested in, all the early adopters are done, and we have interest rates on car loans, and consumers are reluctant to pay the premium that you pay for electric. If you compare two side by side, electric costs more, which is why the electric vehicles, for vehicles that are more economically priced, they want that $7,500 government subsidy to make it more affordable. And lastly, charging infrastructure. There's been a couple articles. I read one recently in one of the popular large news publications that you can go Google it. And this reporter, she drove around Los Angeles and everything trying to get recharged, and she was counting the number of times out of order, wouldn't take credit card, or it had just been vandalized and broken. 40% of the chargers she went to were unusable. And these all have to be the fast charger, because if you have an EV, you know that you need a supercharger. That's what Tesla calls them, the supercharger stations, because in about 20 minutes you can get more than 50% into the battery. That's big. So plug in your car, go get a burger, come back out, 20 minutes, you're done. The average time to gas a car is 7 minutes. So it's about 3 times longer, but nonetheless, that's supercharger. All the small chargers, like going to the mall, you plug that in, give it a credit card, and it's low power charge. You may only get 10-15%, and you're in the mall for an hour and a half. So it's helpful, but the charging infrastructure, people that own EVs are starting to complain about them. Hey, there's only 5 of them at my work, and there's 15 people have cars now, so I don't get to charge at my work unless I get there early and I'm the first one there, and then I plug it in. Or I plug it in at home. I recently added a charger to my house along with a 40 amp fuse, and I did it right in the garage, right next to the fuse panel, and I have a fairly new house. Well, guess what? It was almost $1,000 between what I paid the electrician to come do it, so it was done properly. So if I ever sell the house, this is done properly, this is licensed, this is to code, as they say, and I put on one of the charge boxes in the garage with a 25-foot cord onto it and a cord gatherer. So to do it right, that was like $1,000. So even if it's done economically, it's still costing you, most consumers, about $700. Have an electrician to come get your garage ready and put a charge box there. So that's a cost on top of buying the car. So the charging infrastructure is really starting to show up in that we don't have enough service stations. Recently, you can go back and look at the Fisker case study that I did, and I talked about charging infrastructure and also talked about it in the Tesla case study, pointing out that there's a side of Tesla that is like Chevron and Exxon. It's at the service stations for your EVs, and they're making contracts with everybody. So it's another way that Tesla, Elon Musk, you know, crazy like a fox, now we're all paying him to charge our EVs no matter what. Now, lessons for you and me. I hope that was useful and lucid and you see what's going on there. It says, first of all, you got to have product market fit. The first customers for something like the Lucid Air can be an illusion. Those can be early adopters. The second customers are critical. In other words, you start repeating it and gaining momentum, and you codify your sales systems and you replicate your sales cycles. That's what's important. Because if that's not happening, all you had was early people that ran out and said, that's very cool, I'll buy one. Those are your early adopters. Then you need to get to the second customers, which is regular customers being attracted by your marketing, going in and buying the vehicle. Product market fit is everything. And I'm wondering if Lucid really has long-term product market fit, given that the demand is kind of loosening up on these, but they appear to be nice cars. But just because they're nice cars doesn't mean someone wants to buy that rather than the new Mercedes, rather than the updated Tesla Model S. Maybe there's PMF going on. Then forecasting. TAM and SAM is everything. Total available market, serviceable available market. Total market for EVs, wow, there's a big market, I could go out and do this. But what about the serviceable available market for yours, the people that would buy yours that you can reach? So you could say that there's 330 million people in America, and 200 million of them, you know, are, you know, the total market for jeans, denim jeans. But when you get down to the kind of jeans you're making, whether it's women or men's or, you know, kids jeans or like old Levi's, Wranglers, suddenly the serviceable market is less. You have to understand this. And it feels to me like EVs, that they're kind of only looking at big picture. They're not really looking at the number of competitors in EVs, charging infrastructure. So forecasting is really key. It's also key for you. Everything I just did, if you Googled SAM and TAM, just type forecast, SAM and TAM, TAM and SAM, you'll find articles written about this. I think will be very helpful for you forecasting your business, which is critical, especially now with the economy that is burping a little bit, to kind of have a forecast, trim it down a little bit, and be ready for, you know, whatever the economy throws at you. And lastly, beware the math and control the dialogue. If you're out there trying to get investment, you know, you can't allow the investors to say, Well, you lost $227,000 per car. You say, wait a minute. Technically I did, but I knew there'd be a loss here. Here's the chart with the reasonable forecast that shows how in the future we're going to cross the line to profitability. Because if you don't, the media will find something to write about, and those media headlines about the losses per car are technically correct based on math, but it fails to point out that, hey, this is only a year and a half since launch, or 2 years since launch. This company never said that they would be profitable until the 4th year of selling these products. So lessons for you and me, I think, are in there, whether you're building a case study right now on a given market that you want to get in and put a business plan against that case study for the market and its growth, because that's what you're going to be doing, building a case study to talk about the market growth and what you believe, and then here's the business plan for something that you believe is going to be successful selling into that, and this is why you're the people to do it. Anyway, that is the breakdown of Lucid. You can see I think they got some headwinds and some challenges ahead, but maybe they come out of it. But thank you for the suggestion. If you got suggestions, put them down below. What would you like to see me cover? I'm looking forward to doing the next case study. I'm looking forward to breaking it down for you. And now, let's go back to the main studio and wrap up. All right. I hope that was useful to you and good information. The Lucid case study is one of my favorites of the last couple months because there is such things that we can apply exactly to startup businesses that you may be running right now. And so again, like I like to say, whether you're running a t-shirt company in Berlin or a tech company in California, there's things you can learn and apply as we all get through this economy and build great companies along the way, because somebody's got to drive it through, build jobs, build to the future, and that's you. These case studies here from the Biz Doc archive also might be interesting to you. Please check them out. Subscribe down below and hit the bell so you get notifications. And until next time, I'm Tom Ells with the Biz Doc, and I hope I left you better than I found you.